My name is Wolfram Hedrich, and I'll be your co-presenter today. The ABA's goal is to connect bankers across Asia and beyond to discuss critical issues affecting banking and banks in particular. And climate change and broader environmental risk management is really quickly rising to the top of the agenda now that we're coming slowly out of the COVID-19 pandemic. So this is very topical and timely, and I'd like to thank our host, the ABA, for inviting us to speak. And in particular, I'd like to thank Secretary Treasurer Ernest Lin and his deputy, Amador Honrado, who are dedicated in supporting training programs just like this one. So thank you very much. I'm very honored and excited to be back at ABA. It's the first time since a long time, I think the last in-person annual conference in Manila. So I'm very excited to be back. I lead EY's financial services business consulting practice in ASEAN. And over the past 25 odd years, as both a banker and a consultant, I focus on helping banks and other financial institutions to drive value from the risk and capital management investments, and hope to do some of that today as well. One of the priorities for me here in my role at EY is to further the sustainable finance agenda and help our clients on this transition. So with me today is my colleague Pierre Santolini, who is a director in the financial services risk management practice here in Singapore. He's been advising both banks and insurance companies on matters of risk management for more than 15 years. So I'm very happy to have him here by my side. One of his many focus areas, beside the one today, of course, is how to measure and embed good risk culture in FIs. Also something that is related to sustainability. Some housekeeping points in advance. The session will be recorded and the link will be made available, I think, by tomorrow. You will have the chance to ask questions by entering those in the group chat. In case there are too many and we don't go through all of them because we have a lot of content to cover today, I promise we will take a look at all of them and get back via the ABA with some answers later. In addition, we also want to hear from you. So we've prepared a few polling questions along the way to hear from you about what your challenges are with regards to some of the topics that we're covering today. So without further ado, let me get started with the agenda for today. I'll start with a few intro points around where we are in the broad transformation journey. I'll then hand over to Pierre for a discussion of the regulatory landscape, and in particular the new MAS guidelines that came out in December, which might likely apply to many of the institutions here listening in today. I will then spend another 10 minutes or so talking about scenario analysis and stress testing. This is obviously a topic that we could talk for hours on end, but I'll try to give a quick overview of approaches, and then we'll finish up with some priorities that we recommend institutions to look at in the short term and the long term. So with that, let me start by asking why we're doing this. Why we're here, what are we talking about today? So we're talking about environmental risk, which is of course part of the broader ESG setting, and of course closely linked to the Sustainable Development Goals set by the United Nations. Right, what we're currently seeing globally is an inevitable policy response playing out. Right, national governments are rapidly increasing commitments to tackling climate change in particular, but also other sustainability goals. Right, net zero emissions by 2050 has become somewhat of a mantra in international negotiations, and we see national decarbonization planning, climate emergency declarations, and other stakeholder expectations really all rising and largely built on scientific consensus. Right, so as a result, we expect increasing market volatility with more and more assets become stranded, right, as economies and capital shift to low carbon industries and activities. And you as financial institutions are ultimately at risk due to exposures to assets, clients, and markets that are affected by the transitions and increased physical risks that come with this. And I think more broadly, the role of the financial system in causing but also halting climate change and other environmental risk is now officially recognized and agreed by most countries, I would say. So we move on. What that really means is, in order for us to get that, the financial services industry is really going to or need to transform quite substantially, right? And this transformation is driven simultaneously from different angles, right? We have the finance led transformation, where it's about reporting requirements. Reporting mostly currently is voluntary, right? Under TCFD and other not regulations, but recommendations, where still some banks have already started that, but there's still a long way to go. We have on the other side the risk and regulatory-led transformation. We see a huge momentum right now in the regulatory response, driven in part by ever-increasing attention regarding climate change and pressure from the public. Pierre will focus that in much more detail later. Right here, the attention is really first on climate risk, right? But other environmental risks like biodiversity are really coming to the fore very quickly. But also social factors, right? If COVID-19 pandemic has shown one thing, is that we do need to pay more attention on the social economic effect of such events. So that is another focus as well. Most actions today are still voluntary and non-binding, right? By increasingly, regulators are introducing more binding requirements, right? So the first trial stress testing exercises are being done this year in parts of the world, and regulators do this largely by while maintaining sufficient flexibility to account for changes and evolving practices, right? Now, what I would like you to first take away, right? While a lot of these things nowadays are voluntary or exploratory, this will become very quickly binding, right? And I think TCFD is a good example. This will be one focus at COP26 in November in Glasgow, where the drive is really to make more and more of this binding. And the UK government has already set in stone that they expect by 2022 all listed companies and large asset owners to comply with TCFD. Right, so this is coming and it can go really quickly. So even if your regulator in your jurisdiction is not doing it, somebody else might do it. And you need to watch out, because a lot of these regulations that are coming might have extraterritorial effect. So for example, the requirements that come out of the US around this, the European Union around disclosure. But last but not least, I think this is a really huge business opportunity, right? Mark Kearney in his Road to Glasgow speech put it, try to sum this up, right? This will require a whole economy transition, with every company, every bank, every insurer, every investor need to transform. And he said this could turn an existential threat into the greatest commercial opportunity of our time. And we do see individual institutions already stepping forward with more aggressive targets and commitments, but also with a positioning in the market around sustainable finance offerings, right? That makes clear that they have realized the opportunity from this transition, the business opportunity from this transition. So this is why ultimately we think this is really needs to be embedded in a broader ESG strategy for each organization, right? We encourage you to take a broader look at this. I'm not going to go through all the details here, but it's really about first starting with ambition setting. Why do you do this? What is the ultimate target for your organization? How do you want to position yourself in the market vis-a-vis your customers and the public? And then define the journey over the following years on how to achieve this, right? So how to change, for example, how to change your portfolio between here and the objective, and then integrating relevant metrics and incentives throughout the organization. So for example, changing your underwriting standards or charging explicitly for warming potential. So as I mentioned before, even if your regulator now is not doing this, you should look at this already, right? Some are already moving. We'll talk about MAS in a second. But it's also because there's a co-creative process at play, right? Regulators expect or look to the banks to help further develop these methodologies, right, in a step-by-step approach. So it's not a once done kind of approach, but it's an iterative, emerging approach as a lot of these approaches and methodologies that we discussed today are still being developed, right? Data challenges are very pervasive in all of this, and this will only get better with increased demand from institutions like yourselves. And last but not least, there's a huge educational challenge here as well, right? For your board, for your own employees, right? Australia came out this year, has the world's first legal opinion with regards to the legal responsibility of directors when it comes to climate change. And I think that's a harbinger of things to come. So really educating your organization from the top down will become a very important part of this overall transition. So with that, I'd like to hand over to Pierre to take us, after an initial polling question, through the regulatory agenda. So with that, Mick, if you're listening, if you could start it, there you are. This works perfectly. So what is the status of your bank's ESG strategy? Where are you at? I'll give you a few seconds to respond to that. It's good to see so far only minority has said not a priority, so that's turning out well done. But certainly some need still to look at that. Let's give it a few more seconds. Okay, while there are still responses rolling in and keep them coming. First stock taking, so number A, developed and rolled out across the bank, 37%. This is very encouraging. Congratulations. B, 18% is also good, right? But it's important, for example, if you have a group level strategy, but you have a subsidiary in Singapore where it's not yet rolled out, so now you need to look at how to merge the new requirements with your group level strategy, right? 23% are saying that they're in the process of developing an ESG strategy, and 13% say it's not yet developed but will do so by 2022. So thank you very much. I think we can close this, Mick, and move on. Here's the results for everybody to look at. Very good. Thank you. And with that, I'll hand over to Pierre for the regulatory review. Thank you.
Thank you, Wolfram. Hi, everyone. Good afternoon. Really pleased to be here with you today. So I'm going to spend a bit of time on the regulatory part, right? Because, I mean, obviously, you want, right, as banks to focus on the business, right, impacts. But obviously, we cannot minimize the fact that there are also some regulatory drivers at play here. And perhaps I will start just by, giving a kind of quick definition of what we mean by environmental risk, right? So basically, environmental risk arises from the potential adverse impact of changes in the environment on economic activities and human well-being. And basically, the issues that are of concern include climate change. So that's usually, what comes to mind at first, but not only climate change, right? You would have also loss of biodiversity, pollution, changes in land use, right? For instance. And what I'm saying, right, that climate change usually is what comes to the front and perhaps is the primary concern these days. Basically, research shows that integrating biodiversity risk is the next major environmental risk analytics challenge for financial institutions, right? So let's see, perhaps in a few months' time or next year, we'll have a specific webinar dedicated to that impact, right, from biodiversity risk. So as Wolfram introduced, right, environmental risk the risks reside within the wider ESG agenda. And basically, you have regulators that you can see here, right? It's not comprehensive. You have just a few of them and a few items, right, listed out. But regulators require firms, especially financial institutions, to have frameworks in place to assess, monitor, manage, and disclose the impacts of these items. So I don't want to go through, each of the country and each of the item. And I'm sorry if you are in a jurisdiction, right, which is not listed here. Obviously, we didn't have, too much room to list out everything. And to be frank, it's changing almost on a weekly, at least on a monthly basis. I will just call out a few regulators, right? Since we are in Asia, I will talk specifically about Hong Kong and Singapore, and also the UK, right, outside of Asia, because it's interesting to see, some of the linkages and also differences between the three regulators. So the UK really started quite some time ago, and they're quite advanced, right, in terms of the thinking. They have established in early last year an FCA and PRA joint climate financial risk forum, which is really interesting in terms of insight that they produce. And basically in the UK, they have adopted an outcome-based approach with scrutiny and expectations at board and senior management level to exercise effective oversight of environmental risk. As you will see later on, it's a lighter touch as compared to MAS when it comes to what is expected at the customer level, but I will discuss that in a few seconds. Hong Kong has a rather systematic approach that consists of guidelines structured and summarized under 9 guiding principles designed to help develop a governance framework for managing environmental risk. And MAS, I would say they have a kind of activist approach, if I can say so, right, to really engage high environmental risk customers to help them improve their environmental risk management and support their transition towards sustainable business practices. And again, I will discuss that in a few seconds. So you have obviously other jurisdictions and regulators being involved, right? Be it in China, Japan, as you can see here. You have also Thailand, Malaysia, Indonesia. But Malaysia, it's interesting, right? They have issued, BNM has issued a discussion paper on a taxonomy. You may have seen also that Singapore recently did so. There is also one in China, one issued by Europe. So one of the key topic, I think, for the month to come, right, in the region, in our region in Asia, but also globally, right, will be to decide on a kind of commonly agreed taxonomy to classify sectors in terms of, which is, greener and perhaps which is not so green. And we'll see in a few seconds that it will have an impact on banks, right, on yourself, in terms especially of underwriting process and credit. All right, moving on. Okay, climate risk, physical and transition risk channels. These are the kind of commonly accepted 2 key channels of transmissions of environmental risk. So basically, physical risk arises from the impact of weather events and long-term or widespread environmental changes. So, I mean, you have some examples here, and I think, again, when you think of climate risk, these are the ones that you would think at first, right? So they are more long-term, I would say, right? It will depend, obviously, on the scenarios in terms of temperature, right? Global temperature increase. But it will have a direct impact on the bank's own physical assets and also on the assets of their customers, right? So that will have some implications on the underwriting process and the credit process. And basically, you as a bank, right, will need to be quite detailed in terms of identifying what are exactly the impacts of on your own assets, right? You can think of the buildings, real estate that you have. Obviously, depending on their location, there might be very, very different impact. Transition risk perhaps is not that much thought of at first, but it's also extremely important, right? It arises from the process of adjustment to an environmentally sustainable economy, and it includes changes in public policies, disruptive technological developments, right? You can think of, obviously electric cars and that exist, but also technologies going forward, based on renewable energy, being more efficient, etc. And also the shifts in customer and investor preferences, right? And there is, as you can see here, a big component in terms of reputation also for the bank. So here, the transition risk actually, since it comes, from governments, regulators, etc., it can come quite quickly, right? And you are good until suddenly you're not, because there is a major shift in the policy. And I guess what we are seeing now in the US is a good example of that one, right? A kind of sudden shift linked to a change in administration. So there will be an inevitable policy response here, and so which means that we might go to the house state first and then see policy responses. So it's not something that you can wait for until you're worried about, right? Because the moment it happens, it will be too late to do anything. And that's where the risk to the financial system comes from, right? So really, I think here we're talking about monitoring regulatory developments, policy responses, right? And to make sure that you are as much as possible proactive and forward-looking rather than reactive. Now, having set this context, I will move on to the MAS guidelines itself. I mean, as you've seen with the regulatory landscape, right, Singapore is not the only country coming up with a piece of regulation around that. But I would say that Singapore or MAS, actually, they've come up with quite a well-structured paper. So basically back in December 2020, after a consultation of 6 months, right? And also an industry task force came up with some handbook on implementing these guidelines, right, in January 2021. So it's really interesting, right? If you want to look deeper into that, I really suggest that you have a look at the handbook, because it gives practical examples of how you can apply these guidelines if you are a bank, an asset manager, or an insurer. The guidelines apply to locally incorporated banks, right, in Singapore. And when I say banks, actually, it's also insurers and asset managers. But since we are with the ABA, I will talk about banks specifically. But basically, so locally incorporated banks and subsidiaries of foreign banks in Singapore, right? But also all the downstream subsidiaries and branches in Singapore and overseas. Which means that if you are, outside of Singapore, but actually you are part of a branch which reports directly to Singapore, to a Singapore headquarter or Singapore entity, right? You might be quoted within these guidelines. So that's really important for you also to understand what it's about, even though I'm sure you will get guidance from the Singapore entity. As I was saying, it applies obviously for banks, but also for insurers and asset managers, right? So each time you have investment activities, right, you would have also the guidelines for asset managers, which would apply. You have different topics here listed. The governance, risk management, disclosure are topics, and I will discuss this further in a few seconds, are topics which are common, right, across the different type of financial institutions. Then for insurers, you would have some specific expectations from the MAS in terms of underwriting and investment. And similarly, for asset managers, they would have specific expectations in terms of research and portfolio construction and stewardship. Right? And the stewardship part is interesting, right? It links back to what I was saying in terms of activist approach. That is to say, how through the investment management, right? You can support investing companies in terms of their effort towards sustainable practices. Okay, now let's have a closer look at governance, risk management, and disclosures, and then the next slide will be more on customer and portfolio level. So when it comes to governance and strategy, I think here the key idea, obviously, is to make sure that it's well embedded within your business strategy, your risk appetite, right, overall, and especially that you will have, designated individuals and committees to oversee that specific risk, right? And it ties back, some of you might know, right, to the individual accountability and conduct guidelines, which MAS also released late last year in September, right? And basically trying really to identify who are the individuals and the committees accountable for that oversight, right? So there needs really to be clear allocation of responsibilities for these across the three lines of defense. Risk management, I won't spend too much time on that. I think it's quite obvious, right? Environmental risk is just another risk category, right? So with its specificities, but at the same time, the broader kind of enterprise risk management framework and process should apply to it, right? So you need to have a framework, policies, processes, right, in place to identify, assess, mitigate, and monitor the risk and the material risk exposures. And you need to build also capabilities, right, internally to incorporate emerging issues relating to environmental risk management. And last but not least, disclosure. Again, I don't think we need to spend too much time on it, right? I think it's self-explanatory. So there is an expectation that, once you've done all that, there will be some public disclosures on environmental risk, and usually a framework that many firms are already taking reference to is the TCFD framework. Okay, now, next topic on customer and portfolio risk. I think here this is really specific to banks, and that's really the interesting part. So basically, at the customer level, the MAS is asking banks, right, to undertake an environmental risk assessment of each customer, as part of the assessment process for basically credit or facilities or capital market transactions, right? So this links back to what I was saying earlier in terms of the taxonomy, right? It will be important to have a kind of agreement, at least at the country level, but even better, regional or global level, right? In terms of, what are the sectors which are greener, than others, which are the ones which are in transition, which are the ones which are really not good at all, right, in terms of from an environmental risk perspective. And basically, the bank will have to come up with a kind of sector strategy, right, in terms of where they want to focus and what they want to do with the customers, in the different buckets, right, depending on the profile, their individual profile as customers, but also the profile of their industry. Then, depending on that is up to the bank also to put in place some enhanced due diligence, also to see how they want to engage their customers, to help them, to support them, right, to improve their environmental risk profile and support that transition. And also potentially, right, to consider mitigating measures like, applying limits, reassessing the client relationship, for instance. When it comes to the portfolio level, Wolfram will discuss that in a few minutes, right? The topic of scenario analysis and stress testing is really at the core, right? Again, similarly to what you would do for any kind of risk category, but obviously there will be some specificities here. And as I was saying earlier, last but not least, really review capacity building, provide training to staff, because I think over the long term, right, beyond the mere regulatory requirement, it's really to build a green culture within the financial institution and financial system. All right, with that, we will go to the second polling question, right, on scenario analysis and stress testing. So if you can help. Okay, I'm launching it. So basically here, that's a multiple choice question, right? We're asking you, what are the top 3 concerns that you have about implementing climate risk into your existing stress testing capabilities? You can choose the top 3. So A, integrating environmental risk data. B, calculating the company level climate exposure. C, understanding the climate risk scenarios. D, securing resources, i.e. budget and technology to adapt stress testing tools. E, building internal capabilities. Or F, you're not aware that it is a priority for the bank. And which can happen, at least after the webinar, you will have a different position, hopefully.
right, while the responses are coming in, I realize we should have put another answer category there saying all of the above, because this is relatively evenly split, right? Understanding the climate risk scenarios is number one, closely followed from integrating environmental risk data. I'll talk about those in a second. Calculating company level climate exposure, close third, and then securing resources and internal talent. Good, we'll give it a few more seconds for everything to come in. But I think what you all say here, right, is very reflective of the discussions that we are having with our clients across the region, right? This is an emerging kind of area of risk management, right? And as I'll talk about this in a second, it's quite new in many ways, right? So there's a lot of uncertainty currently in the market. And I don't think that will go away that quickly, right? And it's upon us as the industry together to experiment, right? Learn from the approaches and then improve over time. Now, where this is all starting, and I think we can end the polling now and share the results first. Sorry, Mick, if you be so kind. There you are. So again, understanding the climate risk scenarios, integrating environmental risk data, the first two, closely followed by company level climate exposure. And that brings me exactly to my next page here. Because of the heart of it is really a question, where do we start, right? With taking a very broad view here, most assessment methodologies, right, are based on deterministic modeling. So much is largely the same. But where they differ is really how economic modeling and ultimately the impact assessment on companies and individuals is approached, right? And as always in risk, we have bottom-up approaches and we have top-down approaches, right? And this consideration applies both in a certain way for the scenarios or the climate models that you choose, as well as how you translate that into risk drivers and impact in your portfolio and balance sheet, right? And of course, those need to link somewhat together. For example, if you do want to have asset level impact, for example, for physical risk on real estate, you do need to make sure that both the climate models, the hazard models that you employ give you that level of granularity for the region and the geolocation that you're interested in. Now, obviously, top-down is easier to do, as in all of these, right? Both from a scenario or the climate modeling perspective, and then linking it to impact. In the climate sense, we measure emission against global carbon budgets and translate those into economic impact, right, at macro or maybe sector level. That's good for long-term planning because country-level emissions are relatively reliable in the long term, right? But of course, it doesn't give us the granularity on a sector level or name level that we need for some of the purposes. And as we can already see from some of the regulatory expectations, at least in part, a top-down approach will not be enough for what they expect to do, right? So the BES in England, in the UK, will require single names to be tested, right? On the other side, a bottom-up approach, right, going from a firm, from a company level up, will of course give us more accurate near-term results in particular, right? And certainly more details on how all of this impacts supply chains of companies. But on the other side, we need more data. We need more data from our customers that we currently don't collect. And it becomes increasingly difficult to really model this with quantitative outputs, right? But I think ultimately the answer is not here one or another, but likely a combination and also evolving over time, right? So it's probably, we'll see now use of top-down approaches, used to scale the analysis that you might do on individual name level for certain sectors, right? So obviously full bottom up doesn't make sense from just an effort basis and information basis, but it might also not be needed across all sectors, particularly those that are less impacted by climate change and other environmental risks. Right, so the best combination to choose and the evolution over time will largely depend on your portfolio's vulnerability to climate change, right? Your existing model landscape, the data availability, and many other things. So one of the starting points is really to look at what you have, what you want to use it for, and what is the right combination of modeling approaches out there to apply. Next page. Yeah, that'll come. Okay, so the starting point of all of this, and you mentioned this in your responses, the difficulty right at the start is choosing and deciding climate change scenarios, right? Now, all of these scenarios are typically built around core assumption of global temperature targets or emission pathways, right? There are a lot of scenarios out there, and the sphere of scenarios is expanding rapidly at the moment. So when choosing which scenarios to use, you do need to go through an assessment of suitability, right? In terms of, for example, do the scenarios integrate physical and transitional risk in one? Some of the newer ones and now what's in development do that. But not every scenario and every provider of scenarios and climate models does that. Maybe you do want separate ones for certain portfolios, certain applications. You need to assess the different scenarios, right? There's some standard scenarios that are out there, but largely a large variety. Do you want to align with a certain centigrade change scenario, warming potential, a certain pathway that you believe in? There's a lot of room for differentiation. And then last but not least is the granularity, right? Assess the applicability of the scenario outcomes by sector, geography, etc. Do they cover? Can those scenarios give you the information that you need? And where do you need to expand from the output of those? Now, three sources typically. There are a number of public scenarios. I'll talk about some in a second. Some banks have started developing their own internal scenarios, but that's not necessarily the recommended approach for most banks, I would say. Because it is complex, it requires very specialized knowledge. You will need to hire climate modelers. So not typically the approach medium-sized banks would use. And then third, the option to choose some of the vendors that are out there that aggregate that and combine this on most likely a combination of this. The network for greening the financial system, so the organization that brings together, I think by now more than 80 organizations, 60 plus regulators and other organizations, has come up with a set of commonly kind of looked at scenarios. There are 3 core scenarios and 5 expansions that look at different temperature targets, policy responses, and technology pathways, but really 3 representative scenarios around an orderly, a disorderly transition, and the hothouse world that Pierre mentioned before, right? So different scenarios depending on what we expect the world's reaction to this to be in terms of a policy response. They're rapidly becoming kind of the go-to set of scenarios for the regulatory, at least the first exploratory stress testing exercises by regulators. So the UK is based on that. France is looking at that. HKMA in Hong Kong is referring to those, likely APRA as well. So it is quickly becoming a standard here. So, yeah. Pierre is kicking me to move on. There's a lot of stuff to cover here. So what makes this all challenging, right? I mean, at the basis, banks have invested heavily in the last decade, right, into building stress testing capabilities. And naturally, we all want to use all of those investments as much as possible. Sadly, though, there are a number of differences here that make this not quite as straightforward, right? Meaning that at the very least, we will have to adapt and expand on what we have. And in some instances, actually do a new development if we want to capture a specific element of climate transition. So I'll skip the first two. I talked about those. Let's talk a bit about the timelines, right? We're used to, for capital stress testing, to look at a 1 to 5 year kind of horizon, maybe on a quarterly kind of fashion. And we look at it in a dynamic fashion, right? Where we incorporate the bank's reaction to certain stress scenarios, right? Tapping into capital buffers, etc. Now, for the climate side, right, we're obviously dealing with changes that happen across a long period of time, and we're not, quite frankly, in the banking world, we're not used to looking at these time horizons, right? So some of the scenarios typically go out to 2050, some even to 2100, right? So anything between a midterm and longer term time horizon. Now, the other difference is we're not looking at an annual kind of progression. This is way too granular for what we need to do here. But typically it's a point in time. So how would we look like in 2030 and 2050 with maximum kind of 5-year intervals to see a gradual change. So often the starting point for banks is more of a static balance sheet view, right? What if we kept our current balance sheet and hit it with a stress test or a certain climate scenario? But of course, going forward, increasingly, the answer will be, well, how can we incorporate the changes that we take, given our ESG strategy, our investments in that, our increase in sustainable finance, our own efforts to green ourselves, right, and our work with our suppliers. So all of that will, of course, add a dynamic factor that will make this far more complex going forward. But I think the starting position is static. So moving on, and don't get shocked, I will not talk you through the details of what computable general equilibrium models or partial equilibrium models were. But what I want to talk about here is really the secret sauce in all of this. And that is, how do you link a broad narrative with which you start, right? Where you talk about temperature alignment, the social economic context, right? How do consumption patterns shift? What might technology developments be, etc. As a starting point for climate models, right? That use one of different forms, right? And then use the output of that, which is typically relatively high-level macroeconomic impact data in terms of GDP changes, in terms of certain price changes for energy, etc., or carbon intensity. And how do you use that, bring this down to a level that you need to impact the credit stress testing models that you already have, right? So this might be adding a geographic perspective that the global models don't give you. It might be a further drill down into a particular sector that is important for you, right? So if you're in Southeast Asia, maybe you're heavily invested in palm oil plantations, right? Just to pick a random industry. So maybe you're interested in really capturing the effects on that particular industry in a much more granular fashion that those global scenarios and models will give you. And the same is true for acute physical risks, right? You will find macro models that look at global hazards, and increasingly firms provide information that break that down in very granular level for postal codes, or even granular on street by street level. And you need to decide what you need for your purpose and how you can expand existing models in scenarios to give you that level of granularity. Right? Okay, next is coming, I hope. Yes. So all of this sounds pretty complicated, and to a certain degree it is. But again, my message to you, start early. This is an evolutionary process. The regulators are learning, the banks are learning, and data requirements are improving or changing. And a lot of the taxonomy and methodologies are in flux, right? This shouldn't be an excuse to wait and see, because it does take time to build up these capabilities internally. And you need to be prepared for when regulators move, and that can, as Pierre pointed out, be quite suddenly, right? So what I wanted to do here on this page, just to give you an idea, this is coming from discussions we're having currently in Australia. APRA will ask the banks to do a climate vulnerability assessment. It's a different way of saying, look at the risk impact from climate change on your portfolios. But I thought this is a little bit more practical view of kind of the questions and thinking that you need to go through, things that you need to decide for yourself. And all of this, again, might change over time. So you might choose something that is rather top-down on a sectoral basis, less granular for the beginning, right? But that will tell you something about the data that you don't have yet and will need, right? And so you can take a stepwise approach in improving this. So I won't go through all of the details here. I'll leave you to read that at your leisure, maybe Sunday evening or at evening when you can't fall asleep, right? You can read all this. But joke aside, I think there are a lot of questions that you need to ask yourself. I think now is a good time to do a stock taking of where you are at and have a first set of answers to those questions going forward. Now, we talked a lot about climate, but this is broader than climate, right? These and broader than credit as well. The MAS, for example, points out other risk types as well. They talk about market risk, right? If assets that you invest in change, mark to market is impacted. They talk about liquidity risk. Certain of your counterparts become illiquid, or certain assets become illiquid, and that presents a problem for the bank. They talk about reputational risk. They talk about operational risk, and increasingly globally in the regulatory discussions, liability risks are also more and more a focus area. So it's broader than just credit. It's broader than just climate. But the questions that you ask are relatively common across the board. So with that, I know we are running very quickly out of time. I'll hand back to Pierre for what to do and how to approach
this. Yes, before we take time actually to answer any question, right? So I will try and keep it within 5 minutes. So basically what we are saying here is that the journey, right, is a gradual and multi-year one, right? As I was saying, earlier, obviously you want to understand, what are the business drivers? How can you create, business opportunities? I mean, and as a bank, obviously, you need to do business, right? So that's definitely what you want to create, right, over the long term, even though the regulatory drivers may be the first one to address. So you have here on this slide, basically, the kind of different steps in terms of maturity, and so you can also position yourself, right, to see how much work will be needed. So basically, for now, you need to develop, strategy and vision. Obviously, if you fall under the MAS ENRM guidelines, you need to understand, how they will impact you. But I would say that's the same, if you are in any other jurisdiction where you have kind of similar guidelines or regulations. You need to review basically your current governance frameworks, policies, procedures, right, to understand, where are the gaps. Obviously, if you're part of a broader group, right, which is headquartered, let's say, in Europe, right, for instance, obviously you might be able to leverage, some stuff which has been developed over there. You may have also some global sustainability leads who have been identified that you can reach out to also. You will need, obviously, once you have done this kind of first level assessment, gap assessment, right, you will need to carry out or draw the roadmap, right, in terms of timelines, to achieve your agenda, your strategy, and your vision, which is really, your own, right? There is no one size fits all. You will need, obviously, to commence early stakeholder engagement, brief your board and senior management, perform some kind of first level impact analysis, right, to identify, where are your material environmental risk exposures, and obviously track, as I was saying earlier, right, policy development, regulatory development, industry task force developments, right. Once you have done that, obviously you will need to mobilize a program, lay out the foundations. As I was saying earlier, the topic of identifying who's responsible and accountable, right? I mean, in terms of senior manager and also committee to oversee environmental risk, that's a key topic to do. You will need also to start engaging key customers early. Especially those in higher environmental risk sectors, embed environmental risk as part of the broader enterprise risk management framework, perform scenario analysis, update your key risk artifacts, and create a strategy to mitigate these risks. And over the long term, this is where really you want to develop and deliver value creation by promoting a sound organizational culture, right? That's really important, right? The fact that your people, right, will need also to integrate, incorporate, right, this new dimension in the way they do business on a day-to-day basis. I was talking about developing a green culture earlier, and Wolfram mentioned that culture and conduct is a key topic close to my heart, and it is. So this is really what you want to develop over the long term. Also, obviously, the topic of data is absolutely critical, obviously for stress testing, for material risk exposure. So develop a seamless technology to operationalize that going forward will be extremely important. And also develop management reporting and dashboards, right, to monitor and report on exposures to board and senior management. So since we were talking about, not only the regulatory drivers, but also the kind of green-related business opportunities, we have one last polling questions. I will launch the polling, right? So basically, in your view, what are the factors that are limiting the growth of green-related opportunities in your bank? So you have only one choice, right? So A, a lack of agreed industry methodologies. B, a lack of clarity of regulatory and supervisory expectations. C, a lack of customer and client demand. D, you have not systematically evaluated the opportunities, or E, all of the above.
While this is going on, I quickly answer two of the questions that came up. So one question is, are there any tools or frameworks or methodologies? Yes, there are, of course. We wouldn't be the consultants that we are if we didn't come with tools and frameworks. So we have included something in the deck. There'll also be an appendix that talks about this a bit more. I didn't want to make this too salesy a presentation here. But of course, we have those, particularly for MAS guidelines. So do have a look at that. Let us know if you want to talk about this a bit more. The other question was, can you provide examples of stress testing scenarios that relate to or impact a bank's capital and liquidity position? Well, the primary idea is that all these scenarios will impact a bank's capital or liquidity position. But I'll give you an example of how the transfer mechanism there is, and I'll keep this relatively simple, right? But one of the key drivers that under transition scenarios that drives the change there is the use of carbon pricing, right? Or cap and trade mechanisms that more and more governments are introducing, right? So in case there is a carbon price introduced in a country, which can happen very, very quickly, that would mean an additional cost factor for all companies that contribute to carbon emissions, right? So it means that carbon emissions are being priced in. Now that will reduce the profitability of certain industries and sectors, and in some cases to the point where they become unprofitable, right? And that can be on an asset level. So if you talk about an individual, say, coal power plant, right, that right now might be working well and be profitable, but then suddenly, if you have to account for carbon costs and carbon trading costs, might not be, right? So that's one example. The other example might be technological change, right? If suddenly certain technologies become so cheap that they rapidly replace existing technologies, particularly in the energy space, so that might lead to certain investments being outdated very much quicker than you would originally expect them to be. So it might shorten the life cycle of certain projects that you have financed as a bank. So those are just some of the examples here.
Thank you, Wolfram. Yeah. So I think we can close the third poll. Okay, so all of the above is definitely the winner here. So lack of agreed industry methodologies, as Wolfram was saying, there are methodologies out there, and there will be even more going forward, right? I've mentioned earlier the taxonomy, right, for economic sectors. So you have one in Singapore, you have one in Malaysia, China, Europe, and going forward, there will be a consolidated one, I'm sure. Lack of clarity of regulatory and supervisory expectations. I guess it depends on the jurisdictions, right? As we've seen earlier, with the landscape in Asia, definitely it's kind of crystallizing and getting clearer as we speak. And lack of customer and client demand, definitely it's a bit of chicken and egg. There are investor preferences which are shifting, and at the same time, I guess what a regulator like MAS is expecting is that financial institutions like you banks and asset managers, right, also will kind of encourage their customers, right, to transition. So that also, in a way, it creates its own demand, right? All right. Just in a few seconds. I won't go through all of these here. It's just to give you an idea of the kind of solutions, right, that a firm like EY obviously can provide around sustainable finance and that you can find in the market. So I guess, strategy, roadmaps, and assessments, we've discussed that, it's self-explanatory. Operating model in terms of 3 lines of defense, third-party and supply chain risk management, again, I guess that's self-explanatory. Risk and financial exposure, similarly, and Wolfram, I guess, spent quite some time on the stress testing and modeling part, right? Metrics, disclosures, and stakeholder engagement, again, I think we've covered that. What I wanted just to highlight here is the product strategy and design. Perhaps we haven't touched on that one too much, but obviously that's a very big one, right? So you will have to think of what kind of product strategy you want to have going forward. New product design for greener, more sustainable products. Green bonds. That's something that we see more and more, almost every day in the newspaper. So what kind of product governance you want to have around that, and obviously in terms of product compliance and marketing. Last but not least, when it comes to the ENRM guidelines themselves, right? Obviously, you have some different toolkits and frameworks and methodologies. As Wolfram put it earlier, we wouldn't be consultants if we didn't have, frameworks and tools in our back pockets. So and you will have in the appendix of this deck, you will have some further insights, right? But basically, what we're looking at here is perhaps first do a gap assessment, right, against the regulatory expectations, then embedding environmental risk management within the broader enterprise risk management framework, developing stress testing and scenario analysis on this particular risk category, and obviously working on the disclosures. And with that, we're at the end of the deck. I think we took questions all along the way, but we still have a few minutes left if you have additional questions.
There were a few questions in the Q&A section. One really great one, which I think will take a little bit longer to answer, around how national climate change action plans might impact risk management of banks. I would say this can be both an accelerator and a hindrance, depending on the circumstance. But that's certainly something that takes a little bit longer to go into detail. Is there another? I think there's another question. Let's see. Our core customers are in trading, not manufacturers, nor plantation owners. How does this impact us? Now, that's a very good question. The key thing that I'd like you to remember here is if you have trading companies that are involved in trading and are part of global supply chains, they will fall under requirements for their ultimate customers, right? So as more and more companies will be required to disclose their contributions to carbon emissions, right, the so-called scope 1, 2, and 3 levels, right, this will increasingly include a view of the entire supply chain, right? So even if your particular client here in Asia and your particular regulation might not require it because of extraterritorial effects, you might still need to provide that information to their customers in Europe that they're part of the supply chain of. Similarly, for banks that are active in supply chain finance, right, similar requirements will come due to their disclosure requirements. So looking at their portfolio and disclosing on what they're financing and how that contributes to a warming world or to carbon emissions. Right, so it will impact you. It might not be a direct impact, but it's still something that you need to watch out for and take a closer look at. I hope that answered the question. So I think we're at the end of our hour. We could go on forever on this, I think, right? As you can see, Pierre and I are very close to this. This is close to our heart. Again, I'd like to thank the ABA for the support and the partnership here. And this really, I think, enables institutions like yourself to get better informed about these issues. I'd like to remind everybody we recorded this, so this will be made available. Also, the presentation slides will be made available. There's an appendix with more information in it. And of course, if you have further questions on the topic, don't hesitate to reach out to us for more information. So with that, I'd like to thank everybody for your time and attention, and goodbye.